Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Okay, so welcome to today's episode, and this is a solo episode with just me. TJ is missing, mostly because this is kind of a monologue type of situation. So last week, we were teaching a class, and this class was about sellers being reluctant to sell their homes and upgrade, despite maybe lifestyle situation, giving them a big desire or need to upgrade their home. They're afraid to upgrade because they're selling a home with such a low mortgage rate in an environment where mortgage rates are really high today. So I wanted to demonstrate some very important details that should be considered when sellers are making this decision. And I put a real world example together to kind of break this down. So I'm going to go over the real world example, and it will tie into a few of the major benefits. But to give you an idea, these major benefits boil down to tax benefits, becoming your own bank, which is a strategy we use, which boils down to paying off debt, but then using additional cash available from the equity in the home you're selling to subsidize and or compound into additional wealth creation. And in addition, what the appreciation on real estate means for your future net worth by owning a more expensive piece of real estate. So I'll dive in real quick. Let's say in 2018, you bought a $300,000 property. You had a 3% mortgage rate, which netted a payment, including taxes and insurance, of about $1,500 per month. Now, let's say you sell that same property today. So 5 years later, you should sell that property for easily $450,000, perhaps more. But in this scenario, I ran $450,000. After paying all realtor fees and commissions and everything you need to pay, you should net about $170,000 on that property. And if, assuming this was your primary residence, as the tax code sits today, you would net that $170,000 with no obligation for income taxes or capital gains taxes on the sale of the property based on the tax code. Now, you got to get with an accountant to make sure you qualify for that, but most people do. So you have $170,000 net that you can do anything you want with. Now, let's say you go and buy a new property for $700,000. And you take part of that $170,000, you put 10% down on the new property, and that's $70,000. You get a new mortgage with a 7% mortgage rate. So the total payment on this new property is about $4,500 per month. That's a big difference, about 3 times the mortgage payment that you are leaving. And that's where most sellers completely stop the conversation, because that's a very intimidating number when you go from $1,500 to $4,500. So now let's dive into some ways that you can accomplish the goal of upgrading your home. Most people want to do this for, like I said, lifestyle reasons, maybe a growing family, whatever the case may be. There's a lot of reasons people want to, and they're holding back and creating a more uncomfortable lifestyle because of the fear without really understanding the details. So first point is tax benefits. This is maybe the most complicated of the points, but it's a very important one. Now, the fact is, high mortgage rates, there is a silver lining to high mortgage rates. So I'll break that down real quick. The home that you're selling, you're only paying about $8,000 in mortgage interest every year. That's a very low amount, especially considering 2023's standard deduction for a married couple filing jointly is $27,700. So you automatically get a deduction of $27,700 on your tax return. So in that case, the home, the cheaper home you own, only paying $8,000 in interest, you don't actually take advantage of that as a tax deduction because it's less than what the standard deduction is. However, on this new property, the interest annually is about $43,000. So this is where the silver lining of high mortgage rates comes in. $43,000. That is obviously dramatically more. That's $17,100 more than what the standard deduction is for 2023. That means that you have a tax deduction of $17,100 because of the high mortgage rate or the amount of interest you're paying on this property. Assuming an average 30% tax rate for the household, that would result in income tax savings annually of about $5,100 per year. divide that by 12. That means that in theory, you could amend your W-2 tax withholdings and you could actually pocket an additional $425 every month to help cover part of that increase in the house payment, about a $3,000 increase. We've now shaved off $425 of that $3,000 increase with this simple little trick. So that's powerful, the most complicated one. Now let's dive into become your own bank. So become your own bank. Number one is paying off debt. Most people think they have to, or they should, increase or invest all of the net equity into the new home, and that's the best way to make it the most affordable, and that's absolutely not the case. So I ran an example. Let's say that there was $60,000 in debt in the household. That $60,000 equates to about $1,200 per month. So you could take some of that $170,000 in equity, pay off the $60,000 in debt, save an additional $1,200. So now with this hypothetical tax savings and the savings you've made by paying off the other debts you have, we've covered $1,625 per month, shaved off of the household cash flow situation. So now the net payment is only $2,875, and that's theoretically the only payment you have. So now we're talking to upgrade your home, nearly double the home that you are selling for only a cost of about $1,375 per month, which makes this way more achievable. However, we can take it a step further. So now we can say, all right, we've spent $70,000 on the down payment, let's say $10,000 in closing costs, and we've spent $60,000 to pay off the debt. There's still $30,000 left over. So say that $2,875 payment's still too high. Well, you could take that $30,000, throw it in the bank in a money market account or whatever, and you could subsidize that $2,875 payment until you can get to a refinance down the road. So let's say, you want to subsidize $500 per month. So you could make out of your own pocket from your earnings a payment of $2,375 and use the $30,000 sitting on the sidelines to cover the additional $500 to make the entire payment and afford that property even easier. Now, in the future, the idea would be that we're banking on a refinance to save that $500 per month permanently, but that would give you a subsidy on the house for 5 years with that $30,000. Now, let's say the $2,875 equivalent payment. Remember, the payment is higher than that. It's $4,500, but we're shaving off debt to get to a net of $2,875. In this case, if you could afford that, you could take that extra $30,000, and this is where the other side of become your own bank and what I get most excited about, which is the wealth creation or compounding the returns based on the cash. So you could take $30,000. Let's assume a 10% return on investment. Just invest that in, for example, the S&P 500 index in the stock market. Investing that $30,000 at a 10% return on investment in, say, the S&P 500 index in 30 years turns into $600,000. And if you were to otherwise invest that in the property, it would have only saved you about $150 to $180 per month. So that's a massive uptick to your potential retirement savings long-term down the road by just using the money more strategically. Now, the last and definitely not least, the last point here is appreciation. So you're buying this new home, and this new home is theoretically worth $250,000 more than the home you're selling. In this example, you're selling a $450,000 house, buying a $700,000 house. It's worth $250,000 more. Based on an appreciation rate of 5% per year, which is a very modest appreciation rate, that means that every year, because you own the more expensive home, you're adding an additional $12,500 to your bottom line net worth. And this is all relative. So if appreciation rates are higher, that number could go up. If appreciation rates are lower, of course, it could go down. But 5% is a pretty conservative number, matching approximately what the past 67 years has produced in the state of Utah. So powerful number, not to mention the added benefits to lifestyle and solving the emotional needs of why you even wanted to upgrade your house in the first place. So don't let the tunnel vision of high mortgage rates and an increased payment guide your decisions. Schedule a consultation with my team and we'd love to go over your unique scenario and show you exactly what's possible for you and your family. Anyway, thank you for watching. I'm sorry for speaking so fast. We'll talk to you soon.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.